Right. Well, good morning, everybody, or good afternoon, depending on where you're located in the country. So nice to see so many participants here. I know we've worked with a lot of you in various capacities, and great to have you join us for such an important topic here, which is long-term care insurance. My name is Rich Lombard. I am the manager of SRP's participant education team. So again, we've seen a lot of you out in the field while we're out there doing our education. And I really think you're going to get a lot out of today's seminar or webinar rather. So when it comes to submitting questions and contacting us for a consultation, there'll be QR codes throughout to do so. Each slide is going to have a QR code where you can submit questions, and we'll get to those in the end. Your mics and chat are disabled. And then we'll have a slide at the end to schedule a meeting with our team if you'd like to have a one-on-one consultation as well. With that said, I'd like to introduce today's presenter, Amy Lozier. So Amy is a long-term care specialist at Ash Brokerage. They're a trusted partner of SRP for our insurance needs. Amy has been in long-term care insurance marketing for nearly 20 years, has earned her LTCIP and CLTC designations. Amy is passionate about assisting clients and their families with long-term care planning and believes her experience with her own parents and uncle has enhanced her ability to counsel others with greater empathy and understanding. Amy lives in Kansas City, hails from Pittsburgh, and has 2 adult sons. And I think one thing that really stands out to me there is having that greater empathy and understanding. I've dealt with this with my father as well, so that just makes such a great difference when there's empathy and understanding involved with a very sensitive period of time in many people's lives. So with that said, I'm going to turn it over to Amy, and again, we'll take as many questions as possible at the end of the presentation. So Amy, all yours.
Again, good afternoon. In today's discussion, we'll talk about long-term care, what it is, and how long-term care plans can fit into your overall retirement plans. It's not necessarily about buying an insurance product, but it is urging you to have a thoughtful discussion with your advisor and your family about how you would like to receive care if you need care as you age. Hopefully you won't need care, but if you do, your plan is about where you'd like to receive care, who you want to provide that care, how you will pay for it, and how it fits in your overall retirement strategy. Long-term care planning is a family matter. As Rich indicated, please use the QR code to ask questions. We'll address questions at the end. And I encourage you to ask questions because you may find someone else in the audience has a similar question or concern. What you will learn today, we'll talk about, again, what long-term care is, why planning is important. We'll touch on government programs like Medicare and Medicaid, and we'll review private long-term care insurance options. Now, for those of you that attended last year's session, those were themes of last year's event. But this year, we're going to take a deeper dive looking into some actual case studies, clients who've put solutions in place. We'll talk about various ways you can fund plans, tax incentives for business owners, and health underwriting that's involved in long-term care planning. Again, I'm not going to talk about specific products. That's not how this process works. We'll share information to help you determine what your wishes, goals, and concerns are so that when you sit down with your advisor, we can identify an option that makes sense to you. Okay, let's get started. What is long-term care? Long-term care is when we need help with basic activities of daily living. Long-term care is not a location, but it's an event. That care need can take place where you need care at the house, in an adult daycare center, something that I didn't even know existed till I entered this industry. Adult daycare centers can be helpful. Let's say you've got a married couple and one of you has an early onset Alzheimer's diagnosis. And the other spouse still needs to work to support the family. In an adult daycare center, that adult could go to a care center, be with peers, receive healthy meals, have activities, and then, go home in the evenings. Care can take place in assisted living facilities and custodial care, skilled nursing, and memory care. Long-term care is not skilled care, like health insurance, like Medicare. It's not just nursing home care. When we need help with activities of daily living, it's something we don't think twice about. Like this morning, you rolled out of bed, you held your body functions, managed yourself independently toileting. Maybe you had a shower or a bath. You made your way back out into your bedroom space. You got dressed and made your way out to get some breakfast. Those are activities of daily living. Transferring, which is moving around your home, continence, toileting, bathing, dressing, and feeding. When you cannot independently perform at least two of those activities of daily living, or you have significant cognitive or memory issues, that can trigger a long-term care solutions benefits. Long-term care can take place at the house or in these locations. Any solutions we look at would provide benefits for those locations. When we talk about long-term care planning, oftentimes we think about skilled nursing, but most care takes place at the house. About 74% of care is home care, 13% assisted living, 13% skilled nursing. I can talk about my mother and dad. My dad needed care because he needed a walker and he needed standby shower assistance. Dad had had some falls in the bathroom. Bathrooms are, hard surfaced, unforgiving places to fall down. So it would be an ambulance visit, sutures, what have you. My mother also went on claim at age 84 due to an aging brain. My dad received 5 years of care at the house, and then it was clear after my mom had passed that he needed 24/7 care. The situation that really changed our perspective on, dad's not able to stay at home safely was the mailboxes in Pittsburgh, where I'm from. Dad used his walker, went down to the end of the curb and retrieved the newspaper and the mail. He turned around and wasn't sure which house was his. He'd lived there 35 years. So just an example of where one can receive benefits from a policy at the house and then maybe graduate, so to speak, to facility care. With proper planning, your odds of being able to stay at home as you age are greater. The vast majority of us want to be at home and have as little change as possible when we need care. An example of early planning is me. This year, I, in working with some contractors, modified the master suite in my house, widening the doorway into the bathroom to accommodate a possible future walker. We installed a walk-in shower and added, in an adjacent walk-in closet, added washer and dryer hookups so I wouldn't need to go downstairs if I decide to age in place. So by planning early, the cost of construction was less, and I was able to make design decisions at a calmer time than if I wait and end up in the walker and my walker won't fit into my bathroom door. So just an example. So why is long-term care planning important? People are living longer. Life expectancies continue to improve. The fact that we're living longer has an impact on healthcare costs in retirements. Americans are living longer. My dad is 94. I have relatives in Pittsburgh, where I'm from, who live well into their 90s, and 3 that live beyond age 100. This following stat is shocking to me, but true. 11,000 Americans daily are turning 65. We baby boomers are impacting this care delivery system in our country. Care is expensive and costing more each year. In this chart, I'm showing what a year of home care is on average, median costs per month for home care, assisted living, and nursing home care. So this would be 12 months, times that monthly cost to get these annual averages. And then I'm also listing here what the cost could be in 15 years. If we assume care costs are rising at 5%, which in many locations it is, in 15 years, your care costs could double per year. Care is expensive. Now, many of us aren't looking to put plans in place today. We're looking at maybe needing care in 10, 15, 20 years, or maybe even longer. So when people think about putting a plan together, think about having a growth rider so that your benefits remain meaningful if you use your plan decades down the road. Here is a chart showing in 15 years what a 3-year home health care could cost, 3 years in assisted living, 3 years in a nursing home. Now, I'm not saying you have to save and have ready this exact kind of dollar amount for potential future care needs. But if you do live longer and slow down as you age, you may have some care expenses that are beyond what's in your existing retirement plan. So, what's your plan? Let's talk about what your plan is. Here are some basic questions that I ask people who are wanting to create long-term care plans. I ask, do you feel you're going to live a long life? Some will say yes, some will say no, and it's often based on how long their parents lived. But with healthcare today and diagnostics today, we go to the doctors, we take prescription medications, we could live longer than our parents. I then ask clients that I'm speaking with, do you agree that if you live longer, that there's a likelihood you'll need some sort of extended care? Of course you would. As we age, we slow down and we may need some help. That's where long-term care planning comes in. If you need care, would that have an impact on those you love? It sure does. If you have an extended care event, it becomes a family event. If you need care and your family has to think about bringing in care, who will provide that care? How often will you need it? Who's going to pay for it? That's a lot of decisions to be made in a stressful time. And families today are spread out. Our adult children may not be in the area that we are. I have one son that's just out of school and he's local in town, job hunting to find work who knows where. My eldest is back in New Hampshire with his wife. So families are more spread out today. Our adult children may not be in our area to provide informal care. When relatives are close by, often families rely on that adult daughter to help out. But your adult daughter may have a job. She may have a house and children of her own to care for. So it's a big ask, and it's long-term care is a marathon, not a sprint. So if you don't have a plan and loved ones have to step in, it can have some real wear and tear on them. I saw that in my siblings that were local to my parents until my parents decided to trigger their policy's benefits. My family was scrambling to try to fill in the gaps. So if you have multiple children, I'm one of 5, there can be differing opinions on what your parent needs. How much care, too little care? Do you want to stay at home? No, mom should move. Are you spending the right amount of dollars? If you handed your checkbook to one of your children and made them a financial power of attorney, it's very stressful, and it can cause rifts between adult children and their parents. It's wise, I believe, to put a plan in place ahead of time, whether that involves insurance or not. Communicate what your wishes are to your loved ones so that when a care event takes place, you're ready and you're all on the same page. Let's talk a bit about Medicare and Medicaid. Will the government be there to pay for long-term care? There's a lot of misunderstandings among Americans about Medicare and Medicaid. So let me dispel some of that. Medicare is skilled care, not custodial care. It's health insurance for those that are at or over age 65, largely. Medications, doctor's visits, hospital stays. Now, Medicare will cover custodial care in a skilled nursing home, but that's only after a qualified 3-night hospital stay. Medicare will cover the first 20 days. But days 21 to 100, there's coinsurance, right? And beyond day 100, there are no Medicare benefits. And as I mentioned earlier, long-term care planning is a marathon, not a sprint. So long-term care solutions can kick in when you've got a situation that's expected to last more than 90 days, whether it's an accident or disease or aging process. It is expected to last more than 90 days. So it kind of takes us out of that insurance Medicare space and puts us into long-term care insurance. So Medicare offers nothing after day 100. And remember, most long-term care people want to receive at home. Here's some statistics. The average woman's nursing home stay is 3.6 years. For men, it's 2.7. And most nursing home is preceded by some home health care. Let's talk about Medicaid. Medicaid is funded by the state and the federal government. It's designed as a safety net for those who cannot afford to put private insurance solutions in place. To qualify for Medicaid, it's not just the clinical need, like I've got Alzheimer's or my dad needing a walker and standby shower assistance. You've got to financially qualify. And to do so, many of us would need to spend down our assets to financially qualify. Qualified funds, such as our 401k or our 403b, if you've got a school teacher, those are countable assets. If you're working with Medicaid, you've got to agree to income limits, like $2,000 a year income, and that's not where most of us are. Yes, there are Medicaid facilities and some Medicaid beds within other nursing home facilities, but those can be limited. Is that Medicaid nursing home near your home? Is it near the people you love who you want to visit you? Oftentimes people will think about, well, I'll transfer assets to my children, my grandchildren, so that I can qualify. Please understand there's a 5-year look back period. Medicaid could still count that $200,000 that you made available to your granddaughter. Assets can be recovered after death through the State Recovery Act. So with Medicaid, you've got to financially qualify, and Medicaid's going to be calling the shots on where you'd receive your care. Do we want to turn over that control to the state? So let's talk about private long-term care insurance options. So far, we've talked about what long-term care is. We've talked about longevity and the impact of all of us, baby boomers, rising care costs. We've talked about Medicare and Medicaid. So I'd like to take a look at the types of long-term care solutions that are available in the marketplace today. Long-term care is not one size fits all. There's a lot of solutions out there, and I encourage you to schedule time with your advisor to start a conversation about what suits you, the benefits you seek, and how you want to fund a policy so we can tailor a solution for you. Long-term care insurance options. Anything you look at today is going to have tax-free long-term care benefits that are available, as I mentioned earlier, at the house, adult daycare, assisted living, skilled nursing home, memory care units. I talked about how you would need to have a need that's expected to last more than 90 days, and that you can receive your policy's benefits if you have the inability to perform at least 2 of 6 activities of daily living, like dressing, bathing, feeding, toileting, moving around your house, etc., or you have a cognitive impairment. So it's one or the other. Or both. It could be both. My dad still uses the walker and needs standby shower assistance, but now he's in memory care due to an aging brain. All of the solutions we're going to talk about work in this way, either triggering by memory or triggering by 2 of 6 activities of daily living. And remember, the income you receive from any of the policies we look at is available tax-free. Okay, there's 6 types of solutions available in the marketplace today. We're going to touch more heavily on the most common 3. Standalone long-term care insurance, I liken it to a bucket of money and a ladle. So you've got this bucket of benefits and a monthly ladle to pay the people who care for you. It has a smaller recurring premium that you can pay each year or monthly. And you can add growth riders. A lot of us are looking for policies that we hope not to need for a couple of decades. So those traditional policies can grow so that your policy's benefits remain meaningful over time as care costs rise. So these policies, you'll hear people talk about a use it or lose it. If I don't need care, I'll have had peace of mind for paying the premium over those years, but there is no form of death benefit. Does that one thing and does it well, but if you don't need care, there's no benefit. One could liken it to, if my house doesn't burn down, it's not like I can turn to USAA and say, can I have my premium back? So a lot of consumers like to look at hybrid solutions where if you don't have an extended care need, you've got a death benefit that will go tax-free to somebody you love who will replenish the estate. Life long-term care hybrids are very, very popular. You can use an existing asset, pay with cash or life cash value to buy a policy that has a death benefit available to your loved ones if you don't need care. And the larger benefit is long-term care if you do have extended care needs. So one could argue that, with a hybrid solution, you've got living and death benefits. So one way or another, that premium is going to work for you or somebody you love. These hybrid life long-term care solutions can be funded with a single premium or a premium paid over X number of years. Maybe you're going to retire in 10 years, so you want a 10-year premium. Solutions can be individual or shared, and that's the same with traditional policies too. So you could have a joint policy where there's one death benefit available to your loved ones upon second death, or there's long-term care for both spouses. Very popular, these life long-term care solutions. Increasing in popularity, especially with our aging population and longevity, are annuity long-term care hybrids. Some of you might think, am I too old to apply for long-term care? Have I got too many medical conditions to qualify for long-term care? With an annuity long-term care hybrid, you can have an annuity benefit if you don't need care available to your loved ones, or you can have that living long-term care benefit. These annuity long-term care hybrids can be individual, or a married couple can own them. If you don't need long-term care, that annuity benefit remains for your legacy. 3 other types of solutions may be lesser popular: accelerated benefit life. This is where you've got a life insurance policy that lets you just accelerate or use early the death benefit for long-term care. It does not have benefit growth like these other solutions do. The focus is more on the death benefit, but there is some long-term care. Another type of solution is short-term care. For some households that maybe can't shoulder some of the other solutions' premiums, you could have a 6-month, 1 year, or 2-year pool of long-term care benefits with a much smaller recurring premium. Group long-term care. Some of you on this call may have been offered through maybe your state's bar association or through your employer to where you can receive long-term care benefits with an employer discount. But we're going to focus in some of the case studies we're about to look at on these top 3 solutions. Standalone long-term care. This is a traditional policy. There's basically 4 components. And I used my silly analogy already about think of the benefit as a bucket of money and your monthly benefit as a ladle where you can ladle out from that policy to pay the people who care for you. We have growth riders available so that benefit that you pay the people who care for you can grow over time. Maybe you're 50 and buying this policy, and so that policy could be growing over the next 3 or 4 decades for you. Long-term care insurance has a deductible, an elimination period. Usually that means you're going to self-fund your first 3 months of care, after which your premium stops and your policy begins paying out benefits. Early iterations of these types of policies, the industry started in the 80s. So some policies purchased in the 80s, 90s, even early 2000s. Carriers did not have a lot of claims data to inform the pricing. But now, traditional long-term care insurance carriers have the benefit of 3-4 decades of claims data, so products are far more appropriately priced today. Traditional long-term care insurance policies have a lower premium. That premium's tax qualified. The fact that it's lower can make traditional long-term care policies really attractive for your middle income households. And the fact that the premiums are tax qualified makes them attractive for business owners, where you can have the business shoulder that premium. Here's a case study. We're looking at a married couple in their 50s, school teachers they happen to be, and they have a side business, a C Corp. And so we've got a combined annual premium of $5,100. That's for both spouses, that $5,100. That premium is intended to remain level over time while the benefits grow. This couple by age 85 would have a pool of money shareable over $1 million. So one spouse could use it all. They could have an even split. My mother used 3 years, my dad 5. They had a 10-year shared policy. So when my dad needed to go to memory care, he was able to use the 2 years of benefits my mother did not. So by having a shared rider, you've got greater flexibility on how those benefits can be used versus if you've got siloed policies, one spouse runs out, you can't take spouse benefits from the other spouse. By age 85, with this example, this couple would have available to pay care bills at age 85 at $14,000 apiece. Again, the premium's tax qualified. The business, because it's a C Corp, can pay that premium. And remember, when you go on claim, you've got a care coordinator, a claims manager to help you and your family. I talk about kind of shepherding you into care, helping identify care providers in your area, making sure the people who care for you have care plans such as dietary and exercise. My point is with this is not only are these plans helping you financially, letting you pay pennies on, for pennies on a dollar for a dollar of care, but it's not just about the money. When you have a policy, you've got a carrier to help you and your family obtain that care. And there's also some ancillary benefits, like putting money towards widening the door to the bathroom suite, adding grab bars to the bathroom. There's some benefits called caregiver training, where someone from a home health care agency could come to the house and teach the insureds and maybe their adult children that live nearby. How do you pick someone up who's fallen to the floor so you don't tweak their back and or dislocate your shoulder? How do you move someone from a wheelchair to a bed? With my parents, it was things like remove those oriental rugs, they're trip hazards, and where to place grab bars. So just know that the carriers are there to help, again, shepherd the family into that care experience. At this time, I'd like to talk about some tax advantages for business owners. About 20 years ago, tax law passed that made it advantageous for business owners to put long-term care solutions in place. Incentives will vary whether you've got a C Corp, S Corp, or LLC. But when you sit down with your planner, if you own a business, let them know because it may steer us towards or away from different solutions. The business could pay all or part of the premium. And remember, those LTC benefits are still available tax-free. Our federal and state governments encourage Americans to put long-term care solutions in place with these tax incentives. They want to protect Medicaid for the impoverished. A second type of long-term care solution that's increasingly popular here in the United States is the hybrid life long-term care. So you've got a solution that has a life insurance chassis, whole life, indexed universal life, but a permanent life chassis that also has long-term care. You can fund these solutions with cash paid once and done or over time. You can even transfer funds from, say, a life insurance policy you have where you don't need the death benefit anymore. Take that cash value from that one carrier to pay all or part of this life long-term care solution. If you need long-term care, that's the largest benefit and growing benefit within these solutions. If you don't need care, you've got that death benefit available and in tax-free to your loved ones. Solutions today, can be what's called cash indemnity. What that means is you receive your monthly benefit from your policy in cash. That cash would let you pay, say, Home Instead, a home health care agency, but it might also, maybe you've got a retired nurse up the street or an adult granddaughter that's home from college. She needs a job, you need care. With a cash policy, you could pay someone with a license or someone, without. So flexibility. So again, as you visit with your advisor and you like the idea of being able to pay someone without a license, mention that because it can steer us towards solutions. Typically, long-term care insurance policies are expected to last for a certain number of years, 4, 5, 6 years or longer. But we've got a carrier that has a lifetime benefit. Maybe you've got a husband and wife on one policy. They both have longevity in the family. So maybe we'll want to look at that particular solution that has a bottomless bucket of money to where either or both spouses can be on claim as long as is needed. It won't run out. These life long-term care hybrids, increasingly, the carriers are itemizing the premium to show what portion of the premium is for the long-term care. So these hybrid solutions can also be attractive for business owners. Here's an example of a long-term care life hybrid solution. Got a 60-year-old non-tobacco single Texas male. His deposit could be $100,000 cash, or maybe he's got $100,000 in cash value from an idle life insurance policy. Regardless, his deposit to his long-term care carrier is $100,000. By age 80, because we have that growth rider on the policy, his pool of benefits by age 80 is $900,000. Look at that ratio. His monthly benefit would be $9,100 a month. If he doesn't need care, he's got that death benefit going back to his loved ones, tax-free. So living and death benefits from that hybrid solution. And let's say he doesn't go on claim till he's 85. These numbers would be even more impressive because the policy's growing over time. Here in this pie chart, just a different visual way of looking at this example, the client has contributed $100,000. If he doesn't need care, he's got that $100,000 death benefit to go back to his estate. The carrier hasn't really contributed anything. But if he needs long-term care, and over 65% of us do, look at what the carrier is shouldering in the form of the long-term care. So the first 100,000, this 60-year-old male is going to use when he's 85, let's say, this $100,000 first as living long-term care benefit, and then he'd have another 800,000 for more long-term care. The premiums are guaranteed never to increase, and the estate has tax-free death benefit, and he has tax-free long-term care. Here's another solution. Gaining traction every year are annuity long-term care hybrids. This has an annuity chassis, fixed or maybe indexed, but it also has long-term care. Like the traditional policies, like the life long-term care hybrids, it can be a joint policy for marrieds. So you own one policy with one annuity benefit for loved ones if neither of you need care, or you've got that larger long-term care benefit that could be 2, 3, 4 times the annuity benefit. Let's say we've got a couple that has an old style non-qualified annuity with taxable gains. They don't need the annuity for income anymore. So we could do an exchange, paying the hybrid annuity premium with that old style annuity that has gains. The clients would have tax-free long-term care benefits, and we've avoided taxation on those gains. These solutions, again, can be individual or joint for marrieds. These solutions can be a real safe harbor for older clients. Applicant ages go up to age 80 or 85, and with one carrier, with carrier approval, can go up to age 87. So for those who think they've waited too long to buy, an annuity long-term care hybrid could be a really attractive option. And the underwriting is simpler. There are fewer health uninsurable conditions to qualify. There's going to be no labs or home interview. So much simpler underwriting experience, better odds of approval, and for clients that could be age 80 or 85. Here's an example. Case study with an 80-year-old husband, 78-year-old wife. They're both non-smokers. The husband has an idle non-qualified annuity with taxable gains. He does a transfer of that annuity's value into the carrier with the annuity long-term care hybrid, $150,000 deposit. That premium's guaranteed never to increase. That couple would enjoy instantly $460,702 shared long-term care benefit. Each of them initially could ladle out up to $51.10 a month from that shared pool. If one spouse doesn't need care, the other spouse could use all of it. If neither of them need care, we've got that annuity benefit going to loved ones. These policies also have growth, so these are just the initial benefits. And remember, we've avoided taxation on that original annuity and have tax-free long-term care here in this solution. My next slide. This is my bucket slide. I like this slide. For those thinking of self-funding their long-term care, long-term care is expensive. If you've got cash on hand, you could pay $1 of the cash on hand for $1 of care. If you're thinking of utilizing other assets in your portfolio to fund your care, depending on what you access and when, there can be tax implications. If you're looking at assets held outside your retirement plan, stocks, mutual funds, real estate, taxable gains, you could pay more than $1 to get that $1 of care. If you're looking at using qualified money, 401k, IRA, 403b, again, you could be paying more than $1 for $1 of care because there could be taxes involved. And how quickly can you obtain that asset? Are you having to sell property? residential or commercial, to pay for that dollar of care. I suggest you talk with your wealth advisor about peeling away some of your income or assets under management to explore an insurance solution where you could be paying pennies on the dollar for a dollar of care. With the Pension Protection Act that became effective in 2010, we allow tax-free exchange carrier to carrier. In my early example of that 80-year-old husband and 78-year-old wife that have a non-qualified annuity with taxable gains, we can take that in a tax-free exchange and purchase that annuity long-term care for both spouses, and that's supported by that Pension Protection Act. It's a Section 1035 exchange. Life cash value from an idle life insurance policy could pay all or part of a hybrid long-term care solution. So when you sit down with your wealth manager and discuss putting a long-term care plan in place, you could fund your policy with cash or a mix of cash and maybe a 1035 exchange. Insurance has underwriting. At Ash Brokerage, where I'm employed, we have a philosophy of doing underwriting early before you apply for insurance. When you're looking at long-term care solutions, one of the biggest unknowns is health. With the medications you take, surgeries, joint replacements, therapies you're undergoing, are you insurable in the eyes of these carrier underwriters? So what we do is, as part of that planning process, when we're talking about, what kind of benefits do you want? Do you want to be able to pay someone without a license? How are you going to fund a policy? We also like to obtain health information. We make that information anonymous, like I would be 65 Kansas female, and we send that information securely to the carrier and ask them, does this person appear insurable? Looking at meds, how recently you've come into the doctor, what are your diagnoses, therapies, surgeries, what have you. And the carrier then will respond with, yes, we'd like to insure this person, quote, at this class, or maybe the client just started taking a new med. So the carrier might say, let's wait 3 months till you apply, till that medication has been known to be effective, and then apply. So we're big advocates of health underwriting. It can help us present solutions, insurance solutions to you that are compatible with your health history. So today we've recapped rising care costs. We've talked about how Medicaid and Medicare can or cannot be there to help fund your future care needs. We've talked about some of the types of solutions that are available in today's marketplace. Standalone long-term care insurance with recurring premiums, or hybrids with life insurance or annuity chassis offering death and long-term care benefits tax-free. But regardless of the solution, we are hoping that you will, through information from this event, sit down with your wealth manager, schedule a private appointment, have a conversation, and formulate a plan, whether it involves insurance or not, and communicate that plan to your loved ones so that everyone is on the same page should you need care. I thank you for your time and attention today, and now I'd like to turn the presentation over to Rich for some question and answer.
Absolutely. Could we just advance to there you go. Okay, perfect. We haven't received any questions yet, guys. So if you have any, please, feel free to submit those. But a couple come to my own mind. Amy, thank you for sharing about, your parents and how that, generally went for you. What would some suggestions you would have be for people that are, considering putting their parents into, say a nursing home or assisted living home? It's a very difficult conversation to have. Any suggestions along those lines to make that maybe easier?
A couple of thoughts. One thing that helped my family, and I never would have thought of it on my own, is journaling. I live in Kansas City, but all of my people are back in Pennsylvania. My siblings who had more routine exposure to my mom and dad were able to observe some things. Mom started leaving chocolate chips out of her famous chocolate chip cake. The library she visited very routinely. She had some difficulty getting home. Um, so my parents, my siblings, my dad would write down, the archdiocese would send a calendar every year, and they would just make little notes about these situations. Or my dad had a fall in the corridor and an ambulance came to the house. But they would journal these events. A lot of times as we age, husbands and wives will go to the doctors together, or their adult children might go with them. Bring those little notes, get that incorporated into your chart, because a physician is always involved in making benefits available. And if you have in the chart those incidences of memory situations, those incidents of falls, or where 3 days worth of medications were taken at one time, write that stuff down, get it in the chart, because when a carrier is going to look at needs, or you're looking to place a relative in care, it is helpful to know history so that they can identify the level of care so that you can trigger your policy's benefits. So journaling is one thing. And I would also encourage people to talk about long-term care planning. November is Long-Term Care Awareness Month. And I don't know if it's because a lot of us gather around a dining room table and we're, looking at the little cute grandkids, and we're also looking at mom and dad aging. It gives us an opportunity to observe how we're doing, and maybe not at the dinner table, but when you get together for family gatherings, ask the question about, it's an uncomfortable conversation, but one that's worth having. If you need care, would you want it to be in the house? Now, maybe your mother's a widow and she likes the idea of going to assisted living or going to skilled nursing because she doesn't want to be alone. She wants the activities and the camaraderie and the safety that would come living in a facility. So just having a conversation about aging and asking people what they want, just as if you might say, Dad, do you want to be cremated or buried at Arlington? A conversation my family had. Having those conversations earlier can help a family stay united, help them be on the same page. I don't know if that answered your question, but those are just some thoughts that hit me.
Absolutely. And we got some more here. So the first one is, I needed to hire a fiduciary to handle my trust and execute my wishes for care. How do I look for and evaluate a fiduciary, and what types of fiduciaries are available?
That would not be a question for me. I would defer to your wealth manager on that conversation.
Okay, fair enough. And then how does it work if the long-term care insurance is a shared benefit, but the couple divorces prior to the benefits being used?
That's a great question. I'm divorced myself. I didn't put my solution in place until I was on my own. But that question is sometimes asked when a married couple or one of a couple is in that consultation. They will ask about that kind of exit strategy. And if that is something that a married couple is thinking about, it is helpful to mention that to the wealth manager, because some solutions are better equipped to be divided. In some, what I would recommend, let's say, my parents had a shared policy. When you are going through that divorce, put that long-term care insurance solution out there. And so in your settlement, you say that you have equal control of that benefits, or the husband's been paying the premium. He's going to be the gatekeeper on use, but you can put language in your divorce as to how that policy can be used. But again, some carriers are situating their solutions that you can divide them into two individual solutions? That's a great question, one that's not been asked before. So thank you, whoever brought that up.
Absolutely. Another one that I think is important here is when getting accepted for LTC coverage, is current health evaluated? I have MS.
There are some conditions where carriers will say no thank you based on a diagnosis. With MS, that is one of those conditions that some carriers are going to say no. But some diagnoses can steer us towards or away from different carriers. It could be looking at an annuity solution, a short-term care solution. It could be that we go through some, in-depth Q&A about your MS, how active it is it impacting already activities of daily living, and then present that information, again, anonymously to that carrier's pre-underwriter and get a feel for, are they interested or not? Or maybe they would approve you at a different class, maybe not preferred best, but it's standard. So this is exactly why we're proponents about pre-underwriting, is let's find out information up front so that if we're going to get you excited about a solution, it's one where we've done our homework and believe we're presenting something that is compatible to your health history.
Excellent. Okay, so another question: at what age is best to get long-term care insurance?
That's a good question, and it really varies. We have some states that are mandating people put long-term care plans in place. Washington State is the leader on that. And so in some of those states, we see, people that are much younger looking. But generally, the people who are actively buying are in their 50s, 60s, early 70s. But, I was just the other day working with a married couple. They're both 40. They're doing quite well, and they know that premiums are going to be lower and their policy would have more time to grow if they bought now. But a lot of folks look in their 50s and 60s. And partly, I believe it's because we are observing our parents aging and needing care. We observe that. We like or don't like what we're seeing. They don't have a plan and we're having to pay for their care, or we're seeing assets that we thought we might inherit being spent down providing care. So as we observe our parents aging, that can be an alarm that goes off to say, honey, let's sit down with our advisor and have an in-depth conversation and decide, do we want to put a solution in place? If so, what type and how do we want to pay for it? So 50s and 60s is a short answer. But remember, we can have solutions from people in their 20s clear up to age 85.
Great. I'll just answer this one. Can you please share the presentation? I missed several slides. We will be sharing the presentation as well, and a link to the recording. Also, so let's just finish up in the interest of time here. Final question. Is there government assistance available?
Medicaid would be available for those, largely skilled nursing, but there's that financial eligibility. Do you have one house, one car, $2,000 in the bank, and you're earning $2,000 a year? So that's an example with Medicaid. So we don't have that type of national health care. And I, am aware of people lobbying and with legislators about that. But at present, we don't have public health care for the aged. And so that's where, you want to, again, have that conversation with your wealth manager and either decide to put an insurance solution in place where maybe that's shouldering the majority of your care, or you're looking at your assets and your income with your wealth manager and dog-earing. This is what we're going to cash in first, next, and last to fund our own care. But sadly, the United States is not with public long-term care benefits.
Thank you. Would you just put up the last slide for a second, please, Amy? The very last slide.
Oh, pardon me. Thank you.
Just want to make
Sorry.
sure they
Thank
have
you.
these numbers as well. All right. Well, thanks, guys. Great questions. And Amy, thank you so much. Very informative. And I know we all learned a lot. I mean, I know I did. And as we mentioned, you can set up consultations with us here at SRP. And we'd be happy to help out. And anyone any questions that we can't answer, we'll certainly use or lean on Amy for her expertise. But again, thank you for joining us. Great to see so many people on this call, and enjoy the rest of your day. Thank you.
Thank you, everybody. Take care.